Alex thinks he made the smart choice. Ryan thinks he did too. They're both wrong. Because Alex believes the path to becoming a millionaire is investing every dollar he can. Ryan believes the path is protecting every dollar he already has. One trusts the market. The other trusts certainty. And over the next 20 years, one of them will look like a financial genius. The other will look completely lost. But appearances can be deceiving. Because when you run the real math, the outcome isn't what most people expect. The difference between their decisions eventually grows large enough to change retirement, lifestyle, and financial freedom itself. And the reason has nothing to do with intelligence, nothing to do with luck, and everything to do with understanding how money actually works. Alex and Ryan are both 25 years old. Both earn $60,000 a year. Both receive roughly 3% annual raises. Both start with $10,000 in savings. Neither receives help from wealthy parents. Neither launches a startup. Neither becomes a crypto millionaire. They're ordinary people with ordinary jobs trying to build extraordinary financial futures. The only difference is one decision. Alex decides to invest. Ryan decides to save. Every month, Alex contributes 15% of his income into a diversified index fund. Ryan contributes the same amount into high-yield savings accounts and certificates of deposit. Both feel responsible. Both feel disciplined. Both believe they're doing the right thing. And for a while, one of them appears absolutely correct. Year one arrives. A market correction hits. Stocks fall. News headlines become negative. Financial experts argue on television. Investors panic. Alex opens his investment account and sees losses. His portfolio is worth less than the money he contributed. Every instinct tells him to stop. Meanwhile, Ryan looks brilliant. His savings account balance keeps increasing. His money never drops. His friends praise his caution. His family calls him smart. When conversations about investing come up, Ryan feels validated. Alex feels foolish. This is where most financial stories would end. But the story isn't over. Because wealth isn't measured after 1 year. It's measured after decades. By year 3, both men have continued their habits. Ryan has accumulated roughly $40,000 in savings. Alex has contributed a similar amount to investments. But market recovery and growth have pushed his portfolio closer to $50,000. The difference isn't massive. Not yet. But something important has happened. The gap has started growing. And once compounding begins working, small gaps rarely stay small. Compounding is one of those concepts everyone hears about, but few truly understand. Imagine a snowball rolling downhill. At first, growth seems slow. Then the snowball becomes larger. And because it's larger, it gathers even more snow. Eventually, growth creates more growth. Money behaves the same way. The first $100,000 is difficult. The second becomes easier. The third becomes easier still. But most people quit before reaching the point where compounding becomes visible. Year 5 arrives. Alex's portfolio approaches $90,000. Ryan's savings account reaches around $75,000. Ryan still feels comfortable. He still sleeps well. He still believes avoiding risk was the right choice. And to be fair, there are advantages. His money is liquid, accessible, predictable, stress-free. Alex experiences volatility. Some years are positive. Others are negative. Some months erase thousands of dollars on paper. Emotionally, Ryan seems to have the better life. But here's what doesn't show up in the spreadsheet. Inflation. While Ryan's balance grows, the purchasing power of his money slowly shrinks. If inflation averages 3% annually and his savings earn roughly 4% before taxes, his real return is much smaller than it appears. After taxes, the difference becomes even smaller. Many savers believe their money is growing. In reality, much of that growth is simply keeping pace with rising prices. This is where the math changes. Because becoming a millionaire isn't about accumulating dollars. It's about accumulating purchasing power. And inflation quietly attacks that goal every single day. Year 10 arrives. Now the gap becomes impossible to ignore. Alex's portfolio has grown to approximately $250,000. Ryan's savings approach $170,000. Both have been disciplined. Both have made sacrifices. Both have avoided unnecessary spending. Yet one account is growing significantly faster. And something surprising happens. Alex's annual market growth in good years begins exceeding his yearly contributions. His money is starting to work harder than he is. Ryan still depends almost entirely on new deposits to grow wealth. This is where compounding begins taking control. But the story isn't over. Because investing has hidden costs too. Market returns aren't guaranteed. Bear markets happen. Recessions happen. Fear happens. During one major downturn, Alex watches nearly 30% of his portfolio disappear temporarily. Thousands of dollars vanish from the screen. For months, every headline predicts worse news ahead. Many investors sell. Many never return. The real risk of investing isn't volatility. It's human behavior. If Alex panics and sells, years of progress can disappear. That's the hidden cost few people discuss. Successful investing isn't just mathematical. It's psychological. Ryan doesn't face that challenge. His balances remain stable. His emotions remain stable. And stability has value. A value many spreadsheets ignore. Year 15 arrives. Alex's portfolio reaches nearly $600,000. Ryan's savings approach $300,000. Both are wealthier than they were before. Both have made progress. But now opportunity cost becomes impossible to ignore. Every dollar Ryan kept out of the market was a dollar that couldn't compound at higher rates. Opportunity cost is invisible. You never receive a bill for it. No notification appears. No warning light flashes. Yet it may be one of the most expensive financial costs people ever pay. Because the greatest financial losses often come from opportunities never taken. Year 20 arrives. Alex is 45 years old. Ryan is 45 years old. Both spent 2 decades working. Both earn similar incomes. Both remain disciplined. But their financial outcomes are dramatically different. Alex's portfolio crosses $1 million. Ryan's savings reach approximately $500,000. $500,000. An impressive achievement by any standard. Yet still only half the result. And this is where many viewers stop paying attention to the details. Because they assume the lesson is simple. Investing wins. Saving loses. But that's not actually the lesson. Here's the twist. Alex only wins if he stays invested. If he panic sells during downturns, the outcome changes dramatically. If he chases speculative investments, the outcome changes dramatically. If he constantly jumps between trends, the outcome changes dramatically. The strategy only works if the behavior supports it. Likewise, Ryan's strategy isn't automatically wrong. For someone approaching retirement, preserving capital may matter more than maximizing growth. For someone with unpredictable income, higher cash reserves may provide security. For someone who cannot tolerate market volatility, stability may prevent costly emotional decisions. Different people face different realities. Different realities require different solutions. The mistake is assuming one strategy works for everyone. The real goal isn't maximizing returns at all costs. The real goal is building a system you can follow consistently for decades. Because consistency beats intensity. Almost every time. Many people focus on finding the perfect investment. Very few focus on becoming the type of person who can stay invested through uncertainty. That's where wealth is really built. Not in spreadsheets. Not in headlines. Not in predictions. But in behavior repeated year after year. Alex became a millionaire on a $60,000 salary because he gave compounding enough time to work. Ryan built substantial wealth because he consistently saved and avoided lifestyle inflation. Both succeeded, just at different levels. And that's an important distinction. Financial success isn't binary. It's a spectrum. The real mistake isn't choosing investing. The real mistake isn't choosing saving. The real mistake is making the decision without understanding the full math, without understanding inflation, without understanding taxes, without understanding opportunity cost, without understanding risk, without understanding behavior. Because once you understand those forces, your decisions become dramatically better, and your future becomes dramatically different. And if you're wondering what happens when someone combines both strategies, that's a completely different conversation. And the numbers might surprise you.